I want to just touch base on the idea of volume return of money at work. I'm just going to bring up, I don't think I can share my screen. I'll kind of go through it. So this is very different. So I'm just going to read from this. I just pulled this up earlier. Volume return of money at work refers to the total amount of profit or return generated by a business or investment, considering the volume of money actively circulating within that system, essentially measuring how much revenue is being produced relative to the total amount of capital employed. So it's unlike return on investment, which looks like net profit against initial cost. Volume return emphasizes the continuous flow of money going out to work and coming back into your system. That's why really infinite banking is it's a cash flow wealth creation system. There are so many attributes to it. And here's an example. Let's say someone wants to purchase a used vehicle. My wife and I did this. Both of the cars we have now, they're a little older, in 2015 and 2016 Hyundais. We really like Hyundais. And we bought both of them, one in 2015, one in 2016, used. They were 2 or 3 years old at the time. And really good shape with a local dealer who knew there were, a lot of guarantees and a lot of good warranty and everything. And we, of course, went to pick them out, and they said, "Hey, let's walk over to our financing guy. We'll finance this thing." And we said, "No, we're going to pay cash." We didn't pay cash. We took loans out from our policies to buy both vehicles, one year, one the following year. And so to the dealership, looked like we cut a check. Well, we took a loan out from our system to purchase the thing. And then what you do is you create volume return of money at work. So how you calculate that is, let's say I looked up some averages for cars. Used cars in the US are typically, for this past year, are about $30,000, $500 a month in payments at about 12% interest rate. So think of it this way. If you have money at work, would be, let's say you have 30,000 in cash, like we did in our system. We take a loan from an insurance company, collateralized by our cash value, buy the car, cash to the dealer. At least they think it's cash. It's not really cash, but you get the point. And then we say, okay, even though we own the car outright, the responsible and wise thing to do as a banker, becoming your own banker, is to pay back into our system. And if we say we decide that, we do the math, we figured that had we financed it elsewhere, it would have been $500 a month. So that's a number we can live with. We can manage paying $500 a month for a vehicle. We were doing it before. We knew how to do this. So that's manageable. So think about this: 30,000 at work, that's the amount of money at work. 5,000 per month coming back in your system, paying back the loan to the insurance company, and that ends up being what is that? Hang on a second. 6,000 a year coming back to your system. And how you calculate it is the money at work is 30,000. There's 6,000 per year coming back into it. So that's 20% volume of money at work coming back to you, helping the whole thing grow. And if you do that for 5 years or more, obviously you don't have to, but the way Nelson Nash talks about it, when you start to function like a bank, you want that money always coming back into your system because it helps the whole thing grow. There are ways to, even when the policy loans are paid back, I work with my clients and teach them there are other places and systems that you can store it in, because sometimes with these policies, there's no more room to put new money into it. So, but we can account for that. And you just start to act like a bank does, where you have money and you put it to work for whatever, whether it's to pay off debt, buy a car, business equipment, loans to other people, whatever the case may be. It's completely up to you, no questions asked, and it's completely under your control. So I'm going to close it up here.